Hey, how's it going, everybody? My name is Troy Hackett, and today we are continuing going through the practice prelim number 2, and we're looking at cash budgeting, which is also called master budgeting if you are in Professor Assis class. And we're just gonna go through it and explain how cash budgeting works, explain where you can occasionally have hiccups with this question, and just make sure you understand this question for the prelim. So, let's start reading through this question, and it says Mary & Kay Inc., a distributor of cosmetics throughout Florida, is in the process of assembling a cash budget for the first quarter of 2011. The following information has been extracted from the company's accounting records, and the first bullet point says all sales are on account, i.e. no cash sales. 60% of customer accounts are collected in the month of the sale, 35% are collected in the following month, and uncollectibles amounting to 5% of sales are anticipated, and management believes that only 20% of the accounts outstanding on December 31st, 2010 will be recovered, and that the recovery will be in January 2011. So let me first break down that first point where it says 60% of customer accounts are collected in the month of the sale. And the reason why that's the case is because just because you make a sale doesn't mean you collect the cash for it immediately. And in this instance, for example, if we make $1 million, we're only going to collect $600,000 in cash immediately. And the reason that's the case is because when people pay, they might buy it, but they might not pay for that product immediately. So like, for example, let's say you buy an iPhone, right? A lot of people who buy iPhones don't pay for it all at once. They make payments on it. So for example, they might only pay for half of the phone immediately, and then they pay the rest of it off in the following months. And they say that 35% are collected in the following month, which is basically saying that if we made $1 million in January, we're only gonna be collecting $350,000 in February. So even though we made the sale in January, we don't collect some of that cash until the following month in February. And finally, it says there's gonna be 5% of uncollectibles, which is basically where you make a sale and whoever bought your product isn't gonna pay you back. Like maybe they went bankrupt, maybe they went to Mexico and they never came back, things like that. And it says finally that 20% of accounts outstanding in December will be recovered, and that recovery will be in January. What they're basically saying that is the accounts receivable account, which is the accounts receivable, if you don't remember, is accounts where you've made the sale but you haven't collected the cash yet. We're only going to collect 20% of that, and that collection will happen in January. By knowing this information, we can actually do part 1 of the question, and part 1 is asking for a cash collections budget for January through March. So I'm going to do January first. So January. So we know that in January we had $150,000 worth of sales, but remember, we only collect 60% of that immediately. So I got to multiply this by 0.6 because we're not trying to calculate sales right now, or we're trying to figure out cash collections, which is when we only physically have the cash, we can mark it down in January. And we only collect 60% of the sales of January in January. So I multiply that by 0.6, and then I am going to add 55,000. This is the accounts receivable. But remember, we're only collecting 20% of that. The other 80% will be uncollectible. And I think that's actually pretty much it. So I'm gonna add those two things together. So when we add that up, we get 101,000 for January. So now let's do February. So February, I am gonna multiply our sales for the month, 180K times 0.6, because that's how much cash we collect in that month. And then I gotta multiply 150K by 0.35, because remember, even though we're in February, we're still collecting cash from January because people are paying late. And we add that up, 180,000 times 60% plus 150,000 times 0.35, and we get $160.5 thousand. March is going to be the same process. We're going to take those sales numbers, 185,000 times 0.6 plus 180,000, which is February, and we're collecting 35% of the revenue in March. And then finally, we actually have to add $5,000 as well. So in this question, they tell us that they're doing some sort of sale of some old equipment and they get $5,000. And remember, we're looking at cash collections right now, and we're getting $5,000 from the sale of equipment. So that would also go into our cash collections because we're getting cash off of this sale of the equipment. So even though it's not part of the sales revenue, we would still count it in our cash collections. So I'm gonna add that up, and I believe we get $179,000. And finally, remember, they're telling us to prepare a cash collections budget for January through March. So naturally, when they ask you this question, you gotta find it for January, February, March, and then find the total cash collections for all 3 months. So in order to do that, we're just gonna find, so for Q1, so Q1 is January, February, March. We're gonna add these 3 up. So 101 plus 160.5K plus 179K, and we get a grand total 160.5 plus 179. I'm gonna get $440.5 thousand. So that's part A, and I don't think it's too hard. Just remember that there is a difference between cash collections and normal revenue, and you need to really understand that difference to be able to do this question. So now that we've done that, I'm gonna do part number 2. So part 2 is asking to prepare a cash disbursements budget for January through March. So cash disbursements is the opposite of cash collections. Cash disbursements is when you spend cash to receive raw goods so you can transform them and then sell them as a product. For example, when Starbucks buys coffee beans from, let's say, Ethiopia, that is an example of a cash disbursement, right? They're paying money to get those coffee beans so they can use it in their store. In order to do the cash disbursements, we gotta read the second bullet point. And the second bullet point tells us that 70% of merchandise purchases are paid for in the month of the purchase. The remaining 30% are paid for in the month after acquisition. So this is basically saying that, let's say we spent $100,000 on coffee beans for Starbucks. We only pay $70,000 immediately, and then we pay the other $30,000 a month later. And the reason this is the case is you'll see that businesses or public companies, they like paying their vendors or their suppliers as late as possible. So by doing that, they're able to keep that cash they need to spend to their suppliers on their balance sheet as long as possible to keep their balance sheet healthy. But that's a little bit more of an advanced topic, and you don't really need to know that. But anyways, I'm getting too deep in the weeds here. So number 2, so we're gonna do January 1st. And we are going to do 90,000 because that's how much they spent in January, and then we're going to multiply by 0.7 because we only pay 70% immediately, and then we're going to add 22,000. So the reason why we're adding 22,000 is that is accounts payable, and accounts payable is an account where we've spent money to, or we've bought this good, but we haven't paid for it yet. And naturally, when you have an accounts payable in a question, you pay it off in the next month, which is January here, unless the question says otherwise. So in this case, I'm just assuming that we're paying that accounts payable immediately. And we got to add 31,000 here as well. So plus 31,000 because that is our operating cost. And I'm going to highlight that, and I am not highlighting. Here we go. Now I'm highlighting. The reason why I'm adding this $31,000 immediately, it says that it's a cash operating cost. So that means we're paying cash to do this operating cost. And when you're paying cash, you're paying it all immediately. You're handing that cash over to your workers, to your hourly employees, and you're not withholding 30% of that for a month. You pay all of that immediately. So when we add that up, we get a grand total of $116,000. So I'm gonna write that down, 116K. And I'm just gonna do that for every single month. So February is gonna be 100K times 0.7. So I'm multiplying, how much we spent in February times 70% because we only pay 70% of it immediately. And then I'm gonna add 90,000 times 0.3 because even though this number right here was incurred in January, we don't pay for some of it until February. So it looks like I forgot something here. I also got to add in my cash operating costs. That's gonna be $24,000. And when you add that all up, you get $121,000. And then finally for March, it's gonna be 140K times 0.7 plus 100K times 0.3 plus the cash operating cost, which is 45K, and we should get $173,000. And so now we have all 3 months. We can add them all up for the total Q1 cash disbursement. So 116K plus 121K plus 173K, and we get 410,000. And just gonna write that down. There we go. So that's part 2, and now let's move on to part 3. So part 3 says prepare a summary cash budget for January through March and use the following format. So this format, it looks quite complicated, but in reality, it's not too bad. And there's one thing we gotta read about here right before we do this part, and that is the last bullet point, which is Mary and Kay Inc. maintain a $20,000 minimum cash balance at all times. Financing is available and retired in $1,000 multiples at a 8% interest rate, with borrowing taking place in the beginning of the month and repayments occurring at the end of the month. Interest is paid at the time of repaying principal and computed on the portion of principal repaid at that time. So this is basically saying that, let's say the company had a bad month and they don't have a lot of cash in their balance sheet. What they gotta do is they gotta borrow money from the bank to get more cash in their balance sheet. And later on, when they don't need that cash anymore, they will repay it to the bank with interest. So what I'm gonna do is I'm gonna go over here, and we know that our beginning, so let's look at this chart here, and they're asking for our beginning cash balance for January. So I'm gonna turn this into black, and we know our beginning cash balance is $20,000. And we know that because right over here, I believe they tell us that our cash balance starts at 20,000. So we get that. And now they're asking for total receipts, and receipts is the same thing as cash collections. And we actually figured that earlier. We know that our cash collections for January is 101,000, and our subtotal is going to be 121,000. So that's our total cash in January. But then remember, we spent some money in January. We spent $116,000. And these figures, I'm just pulling them from part A and part B, and now we're tying it all together in part C. So I am doing that. We subtract our cash disbursements because that's money that's going away. And when we subtract it, we get 5,000. And remember, for this business, they need to have at least $20,000 in cash at all times. So we got to borrow $15,000 as a loan. And by doing that, we have a cash balance at the minimum required rate or minimum required amount, which is $20,000 cash. So now we pull this number over here. So we get 20K, and our cash collections for February was 160,000.5, and our subtotal is going to be 180,000.5, and we spent 121,000. So we do that, so 180.5 minus 121, I get a cash excess of 59,000. So now that we have more money than the required amount, we can actually repay that loan. So that loan is, remember, that's $15,000. So now, remember, our interest is at an 8% rate, but that is at a yearly rate. And what we gotta do is take this 8% and multiply it by 2/12. That basically stands for 2 months. And you might be asking, why 2 months and not 1 month? And the reason we use 2 months instead of 1 month is that we have to borrow money at the beginning of the month, and we can't repay it until the end of the month. So what happened was, when we needed to borrow money, we had to do it at the beginning of the month. So that would have been January 1st. And when we repay it, we can't repay it until the end of the month. So we didn't repay until the end of February, when our cash balance increased suddenly. When I multiply that out, I get an interest rate of 1.33%. And I'm gonna multiply that by 15,000. And by doing that, I get a interest of 200. So I'm gonna do $59,500 minus 15,000 minus 200. And I get $44,300. And remember, I'm gonna bring this number up again because the ending cash balance of February is gonna be the same as the beginning of the next month. So I'm gonna rewrite that, and I don't know what I just did, but we get 44.3 thousand for that beginning cash balance. We made $179,000 in March, or we collected that much cash in March. So I'm gonna add that up, and I get 223.3 thousand. And we know that we have some cash disbursements, which we calculated in part B. So we had 173,000. And when we subtract that, so minus 173,000, we get $50,300. And we don't need any financing, so our ending cash balance is going to be $50,300. So part 3, not too bad. There is a lot of steps involved, but if you just take it, one chunk at a time, it's actually not that bad of a question. And if you can get that right on the exam, it's going to help you out quite a bit. And question 4 says, budgets are used by management for planning and control. Describe how the information contained in these budgets can be used for both purposes. And I think that's kind of a misleading question. I think planning and control are two very similar things. So what I would just say is that from what we've done in this question, it helps us figure out how much we can spend and how much we can sell. And that can help prevent bankruptcy, because if we overspend and we take on too much debt, that can actually lead to a company going bankrupt because we can't get rid of our inventory. And I hope you guys enjoyed this video. As always, drop a like on the video. And if you guys need more help, Professor Paz or I can help you out with that, or one of the other TAs. And yeah, have a great day, and hope this video helped. You know, he's saying that it feels right, it feels right, it feels right. Yeah, you know, he's saying that it feels right.